The financial system isn't broken, it's designed this way. From the moment you're born, your zip code, your name, and your family's economic status trigger a series of algorithms and policies that either open doors or slam them shut. In this video, we'll trace exactly how these systems evolved, who benefits from them, and, most critically, what specific tactics you can use to overcome them. If you've ever suspected the deck is stacked against certain communities, you're right. And I've got the receipts to prove it. But I'm also bringing you the blueprint to build wealth despite these obstacles. A tale of two Americas, the shocking reality of wealth inequality. Imagine two neighborhoods just 5 miles apart. In one, the average household has $6.9 million in wealth. In the other, just $51,000. This isn't hypothetical. It's America today. These aren't just numbers on a page. They represent drastically different realities for families living mere minutes from each other. What we're witnessing isn't simply inequality. It's a Grand Canyon-sized wealth gap that shapes everything from educational opportunities to health outcomes. While we often hear success stories of people who made it despite the odds, these exceptional cases mask a troubling systemic reality. Let's talk about the actual numbers because they're pretty jaw-dropping. The top 10% of Americans now own approximately 67% of all wealth in the country. That means just 1/10 of households control 2/3 of everything. Meanwhile, the bottom 50%, half of all Americans, own just 2.5% of the nation's wealth. Think about that for a second. Half of all households splitting just 2.5% of the pie. But this wealth distribution doesn't just follow economic lines, it follows racial ones too. The median white family in America has about $190,000 in wealth. Compare that to the median black family with just $24,100 and the median Hispanic family with $36,000. That means for every dollar of wealth a white family has, a black family has just 23 cents, and a Hispanic family has only 19 cents. But wait, you might say, isn't this just about education or work ethic? That's the narrative we often hear, but the data tells a different story. Even when comparing people with the same education levels, dramatic wealth gaps persist. A black household headed by someone with a bachelor's degree has less wealth on average than a white household headed by someone who never finished high school. What does this wealth gap actually look like in daily life? In one America, financial security means owning multiple properties, having robust retirement accounts, and passing down wealth to the next generation. Children grow up with access to the best schools, safe neighborhoods, and extensive social networks that open doors to opportunities. In the other America, financial security might simply mean making it to the next paycheck without an emergency derailing everything. It means having no financial cushion when the car breaks down or a medical issue arises. It means working multiple jobs just to stay afloat while watching any chance of building wealth slip further away. This division isn't just about money in the bank. It affects nearly every aspect of life. Families with wealth can afford to live in neighborhoods with better schools, cleaner air, and lower crime rates. They can invest in their children's education from preschool through college without taking on crushing debt. They can afford preventative health care and quality nutrition. And perhaps most importantly, they can take calculated risks. Starting businesses, investing in markets, pursuing advanced degrees, because they have a safety net if things don't work out. What's particularly troubling is that these gaps haven't narrowed over time. Despite economic growth and anti-discrimination laws, they've actually widened in many cases. From 1983 to 2016, the median black family saw their wealth drop by more than half after adjusting for inflation, while median white family wealth increased by 33%. Even government programs designed to help Americans build wealth have often reinforced these divides. Homeownership, the primary wealth-building tool for most middle-class families, was explicitly made more accessible to white Americans through policies like redlining and discriminatory lending practices. While these practices are now illegal, their effects continue to shape wealth distribution today. The COVID-19 pandemic only exacerbated these divides. While the stock market, where wealthier Americans have much of their assets, recovered quickly and reached new heights, millions of working Americans experience job losses, depleted savings, and housing insecurity. The K-shaped recovery meant those at the top saw their wealth grow substantially, while those at the bottom fell further behind. When we look at intergenerational wealth transfers, the picture becomes even clearer. About 30% of white households receive some form of inheritance during their lifetime, with an average value of nearly $200,000. For Black households, that figure drops to just 10%, with an average value of $100,000. Hispanic households fall somewhere in between. These inheritances don't just provide immediate financial benefit, they often fund education, home purchases, and business startups that generate even more wealth. There's also a stark psychological component to this divide. Growing up with financial security teaches children that taking risks can lead to rewards. Growing up with financial insecurity often teaches the opposite, that the system is rigged and taking risks usually leads to disaster. These mindsets become self-fulfilling prophecies that either enable or inhibit wealth building. Some point to successful individuals from marginalized communities as proof that the system works for everyone willing to work hard enough. But these exceptions don't disprove the rule. They simply highlight how extraordinary talent, luck, or effort is required to overcome systematic barriers that don't exist for others. The reality is that wealth begets wealth. When you have capital, you can make investments that generate passive income. You can afford to take entrepreneurial risks. You can leverage existing assets to access favorable loans and financial products. You don't have to pay the poverty premium of higher insurance rates, check cashing fees, or payday loan interest that actually makes being poor incredibly expensive. What's perhaps most frustrating is how invisible these advantages and disadvantages can be to those experiencing them. People born into wealth often attribute their success entirely to hard work, while those born without it are told their struggles are purely the result of poor choices. Both narratives miss the structural realities that shape economic outcomes from birth. This isn't to say individual choices don't matter. They absolutely do. Personal responsibility plays an important role in financial outcomes, but pretending the playing field is level ignores the overwhelming evidence that systematic advantages and disadvantages heavily influence who succeeds and who struggles in our economy. What's really creating this massive divide? Let's look at where it all begins. Your neighborhood. The zip code you're born into shapes your educational opportunities, your network, your exposure to environmental hazards, and even your likelihood of encountering the criminal justice system. These factors combine to create dramatically different starting lines for building wealth. The wealth gap we see today isn't random or primarily based on individual choices. It's systematic and built into the financial landscape of America. It's the result of historical policies, ongoing practices, and institutional structures that continue to funnel resources and opportunities along predictable lines. Understanding this reality isn't about assigning blame, it's about accurately diagnosing the problem so we can find effective solutions. Banking deserts, how your zip code determines your financial options. When we talk about the financial landscape of America, we're not just speaking figuratively. In Manhattan, you'll find 43 bank branches per square mile, but travel to the South Bronx just minutes away, and that number plummets to less than 2. This stark contrast isn't some random quirk of urban development. It's a pattern deliberately repeated across America, creating what financial experts call banking deserts. These banking deserts are neighborhoods where traditional financial institutions are practically non-existent. Imagine walking miles just to find an ATM or having to take 3 buses just to cash your paycheck. For millions of Americans, this isn't imagination. It's daily reality. When basic financial services don't exist in your neighborhood, even simple money management becomes a costly obstacle course. What's particularly troubling is how these banking deserts map perfectly onto demographic data. Pull up any visualization of banking deserts across major cities, and you'll see they overwhelmingly exist in low-income areas and communities of color. This isn't coincidence. It's the first major barrier in a system of financial exclusion that keeps certain communities from building wealth. The Federal Reserve reported that between 2017 and 2021, 1/3 of all bank branch closures happened in majority-minority communities. Think about that for a second. When banks decide which branches to keep open and which to close, they're disproportionately pulling out of Black and Hispanic neighborhoods, making an already uneven playing field even worse. This absence of traditional banking doesn't just mean inconvenience. It creates a vacuum that gets filled by alternative financial services. When there's no bank or credit union around, people turn to check cashing services, payday lenders, and money orders to manage their finances. These alternatives come with steep fees that silently drain wealth from communities that can least afford it. Consider what happens when you cash a paycheck at one of these alternative services. You might pay a fee of 1 to 5% of the check's value, meaning a person earning $25,000 annually could spend up to $1,250 just to access their own money. That's money that could have gone towards savings, education, or other wealth-building opportunities. The numbers are staggering. According to the Federal Reserve, about 6% of Americans don't have a bank account at all. But that figure skyrockets to 23% among those making less than $25,000 annually. Nearly a quarter of working low-income Americans are completely cut off from traditional banking. And when we look at racial disparities, the picture gets even bleaker. Black and Hispanic adults are disproportionately affected by this financial exclusion. The data shows 14% of Black adults and 11% of Hispanic adults lack access to traditional banking services, compared to only 4% of white and Asian adults. This isn't just a poverty issue. It's a systemic pattern that follows racial lines. Let's be clear about what being unbanked actually means in practical terms. No savings account means no safe place to store money, making emergency funds nearly impossible to maintain. No checking account means relying on cash or expensive alternatives for every transaction. No relationship with a financial institution means no credit history, making loans for cars, education, or homes either impossible to get or available only at predatory rates. The Federal Deposit Insurance Corporation, FDIC, reports that nearly 6 million households in the U.S. have no bank account at all, while an additional 18.7 million are considered underbanked, meaning they have some form of bank account but still rely on alternative financial services that come with higher costs and fewer protections. Living in a banking desert creates both immediate and long-term financial penalties. In the short term, residents pay more for basic financial services. Check cashing, bill payment, and money orders all come with fees that add up quickly. But the long-term costs are even more devastating. Without access to savings accounts, credit-building opportunities, or affordable loans, residents of banking deserts face nearly insurmountable barriers to building wealth. Think about trying to start a small business when the nearest bank is miles away, or saving for a down payment on a home when you have no relationship with a mortgage lender, or building a credit history when no financial institution in your neighborhood offers credit-building products. These aren't hypothetical scenarios. They're the daily reality for millions of Americans living in banking deserts. What makes this situation particularly insidious is that banking deserts aren't natural phenomena. They're the result of calculated disinvestment. Banks are businesses, and they tend to locate branches where they expect to generate the most profit. When financial institutions look at lower-income neighborhoods, they often see lower deposit balances, fewer loans, and less potential revenue, ignoring the fact that residents need these services just as much as wealthier communities do, if not more. This creates a vicious cycle. As banks close branches in certain neighborhoods, residents have fewer options for financial services. With fewer options, they're more likely to rely on expensive alternatives or go without banking altogether. Without relationships with financial institutions, they struggle to build credit or save effectively. Without credit or savings, the neighborhood as a whole experiences less economic growth and development. And with less economic development, banks have even less incentive to open branches there. Some might argue that online banking solves this problem, but that ignores several realities. First, many residents of banking deserts lack reliable internet access or the digital literacy needed to navigate online banking. Second, online banks can't provide services that require physical presence, like notarization, safety deposit boxes, or immediate cash access. Third, many online banks still require an initial account opening at a physical branch or verification through another bank account, creating a catch-22 for the unbanked. The most troubling aspect of banking deserts is that they're creating a two-tiered financial system, one for communities with access to affordable, traditional banking services, and another for communities forced to rely on costly alternatives. This isn't just an inconvenience, it's a systematic extraction of wealth from the communities that can least afford it. Predatory lending, the trap behind the storefront. In the vacuum created by banking deserts, a more sinister financial beast thrives just around the corner. What looks like financial help, bright storefronts offering fast cash and no credit check loans, actually functions as a carefully designed trap that turns a single moment of financial vulnerability into years of crushing debt. Take Miss Lily from Greenville, South Carolina. She only needed $700 to make rent, a relatively small amount that many of us might cover with an emergency fund or a quick call to family. But without access to traditional banking services, Miss Lily turned to a local predatory lender. That single decision sparked a devastating financial spiral. 10 years later, at age 70, she found herself drowning in over $15,000 of debt and filing for bankruptcy. Her story isn't an exception, it's the business model. These predatory financial services come in various disguises. Payday loans promising quick cash until your next paycheck, auto title loans that put your vehicle at risk, and rent-to-own agreements that make you pay 3 times the retail price for basic household items. They all share one thing in common. They're designed to keep you coming back, again and again. The interest rates charged by these lenders would make even the greediest credit card companies blush. In South Carolina, the average payday loan carried an interest rate of nearly 400% in 2021. Take a moment to process that number, 400%. For comparison, even high-interest credit cards typically top out around 20 to 25%. This means if you borrow $500, you could end up paying back $20,500 or more if you can't clear the debt quickly. But surely this can't be legal, you might ask. Unfortunately, it is in many states thanks to carefully crafted loopholes and aggressive lobbying efforts by the predatory lending industry. In states with weak consumer protections, these businesses operate with minimal regulation, extracting millions in fees from the financially vulnerable. These predatory businesses aren't randomly distributed. They know exactly where to set up shop. Their bright, welcoming storefronts cluster strategically in low-income neighborhoods and near subsidized housing. Their marketing is specifically designed to appear as financial saviors to those in desperate situations. Need cash now? Bad credit? No problem. Their signage practically shouts relief to people facing eviction, medical emergencies, or car repairs they can't afford to miss work over. The data confirms what's obvious to anyone who's driven through different neighborhoods in American cities. A study by the Center for Responsible Lending found that in Michigan, there are 7.6 payday lending storefronts per 100,000 people in census tracts that are over 25% African American and Latino. These businesses know exactly where to find desperate customers with few alternatives. What makes predatory lending truly insidious is the debt trap cycle it creates. Here's how it typically works. You need $400 for an emergency car repair. The payday lender offers you the money with a fee of $60, due in 2 weeks when you get paid. Sounds manageable, right? But when payday comes, you can't afford to give up $460 from your check and still cover all your regular expenses. So you pay just the $60 fee and roll over the loan for another 2 weeks. And that's where the trap snaps shut. In South Carolina, 46% of short-term loans were flipped or renewed, meaning borrowers couldn't pay them off within the original term. Each time you renew, you pay that fee again without reducing the principal amount you borrowed. 4 rollovers later, you've paid $300 in fees and still owe the original $400. Some borrowers end up paying more in fees than they ever borrowed in the first place. Many people get trapped in a cycle of taking out new loans just to pay off existing ones. One missed payment can trigger aggressive collection tactics, overdraft fees, bank account closures, and even legal action. What started as a small emergency loan becomes a financial black hole that's nearly impossible to escape from. Let's be clear about what's happening here. This is wealth extraction, pure and simple. These businesses are systematically pulling money out of the communities that can least afford to lose it. Every dollar paid in excessive fees and interest is a dollar that can't go toward building savings, investing in education, buying a home, or starting a business. And the impact goes beyond individual borrowers. When predatory lending drains resources from a community, it affects everyone. Local businesses suffer because residents have less disposable income. Property values stagnate when people can't afford home improvements or are forced to sell under duress. The entire economic ecosystem of a neighborhood can be damaged by this parasitic financial model. The geographical patterns of predatory lending also tell a deeper story about how financial exploitation follows the contours of racial inequality in America. The same neighborhoods that were redlined decades ago, denied access to traditional mortgages and investment, are now prime targets for these alternative financial services. It's not just a coincidence, it's the evolution of financial discrimination. But why don't traditional banks step in to fill this need? Banks claim that serving these communities isn't profitable enough or that the risks are too high. Yet somehow, predatory lenders find it extremely profitable to operate in these exact same locations. The reality is that traditional banks have retreated from lower-income communities, closing branches and raising minimum balance requirements that effectively exclude many working-class Americans. This two-tiered financial system with affordable banking for some and expensive predatory services for others perpetuates wealth inequality in America. When your only option for financial services extracts rather than builds wealth, economic mobility becomes virtually impossible. What's perhaps most frustrating is that these practices continue despite clear evidence of harm. Policymakers who claim to care about poverty and economic opportunity often turn a blind eye to these legalized forms of exploitation. In some cases, they actively protect predatory lenders through legislation that preempts local attempts to regulate these businesses. The next time you drive through a neighborhood and notice a strip mall filled with check cashing services, payday lenders, and rent-to-own stores, recognize that you're not just seeing businesses, you're seeing the infrastructure of financial extraction. These storefronts represent the visible evidence of how our algorithmic bias, how AI keeps the financial gates closed. Those predatory storefronts may be the most visible signs of financial inequality, but the most powerful barriers are actually invisible. Behind the screens and servers of modern lending institutions lurks a sophisticated gatekeeper that most never see. Algorithms now determine who gets access to loans, credit cards, and mortgages, and they're making decisions that look objective on the surface, but hide troubling patterns of discrimination beneath. Think about this. 69% of all lenders in America now use AI algorithms to determine who gets loans and who doesn't. That's not some distant future. It's happening right now, according to MasterCard's own data. These invisible systems might seem fair and objective at first glance, but there's a serious problem hiding in plain sight. When algorithms make lending decisions, they're trained on decades of historical lending data. The problem? That historical data already contains all the biases and discrimination that existed in the past. It's like teaching a child using a textbook filled with errors. Those mistakes get passed right along. Let me break down what's happening. When you apply for a loan today, your application isn't reviewed by a person who might have obvious biases. Instead, it's processed by an algorithm that calculates risk based on patterns it's learned. But because these algorithms are trained on historical data, where certain groups were systematically denied loans, they learn to continue those same patterns of exclusion. What makes this even more complex is something researchers call noisy data. A groundbreaking study by economists Laura Blattner from Stanford and Scott Nelson from the University of Chicago found something fascinating. The problem isn't just that algorithms are biased. It's that they have less accurate data about minority applicants to begin with. Here's what that means. If you're from a community that historically had less access to financial services, the algorithm has less information about people like you. Your credit history might be thinner or non-existent, not because you're less responsible, but because you had fewer opportunities to build it. The algorithm sees this limited data and makes less accurate predictions about your creditworthiness. So even if the algorithm itself is designed to be completely neutral, it still produces biased outcomes because the data it's working with is incomplete for certain groups. It's like trying to predict the weather with half your sensors broken. Your forecasts for certain areas will always be less reliable. The Consumer Financial Protection Bureau has been raising red flags about this issue for years. They've highlighted how these credit scoring models can violate the Equal Credit Opportunity Act when they produce outcomes that disproportionately harm protected groups. But here's the kicker. Most financial institutions don't even have adequate systems in place to identify when their algorithms are creating these discriminatory patterns. When an algorithm denies you a loan, it doesn't say, "I'm denying you because of your race or zip code." It simply gives you a rejection based on risk factors that seem neutral on the surface. Maybe it's that you don't have a long enough credit history, or that you've moved addresses frequently, or that you work in an industry the algorithm considers unstable. But these supposedly neutral factors often serve as proxies for race and class. If you live in a neighborhood where people move more frequently due to housing instability, that's not really about your personal reliability. It's about economic conditions beyond your control. If your job is deemed risky because it's in a sector where many minorities work, that's not a fair assessment of your ability to repay. What's particularly troubling is that when researchers have identified these biases, they've found they can't simply be fixed with better algorithms. The CFPB's research suggests alternative credit scoring models could reduce disparities while maintaining predictive performance, indicating that less discriminatory approaches are possible. But the fundamental problem remains in the data itself. The tech industry loves to talk about garbage in, garbage out. If you feed a system bad data, you'll get bad results. But in lending algorithms, it's more like biased history in, biased future out. These algorithms are making decisions based on America's long history of financial discrimination. And they're projecting that discrimination forward into the future. The impacts are devastatingly real. When algorithms systematically deny credit to marginalized communities, it forces people to turn to those predatory lenders we talked about earlier. It creates a vicious cycle where those who most need fair credit can't access it, pushing them toward high-cost alternatives that further damage their financial health. Perhaps most troubling of all is that algorithmic lending creates a form of discrimination that leaves no fingerprints. Traditional discrimination in lending could sometimes be proven in court. A lender might have explicit policies against lending in certain neighborhoods or to certain groups. But algorithmic discrimination hides behind the complexity of code and the opacity of black box systems. The CFPB has emphasized that financial institutions can't hide behind these black box algorithms when making adverse decisions. They're still required by law to provide clear explanations for why someone was denied credit. But in practice, the reasons given are often vague and unhelpful. Insufficient credit history or high risk score doesn't tell you much about how to improve your chances next time. For marginalized communities, this creates an impossible situation. The algorithms say you're risky because people like you have historically had less access to credit, which means you'll continue to have less access to credit, which reinforces the pattern the algorithm detected in the first place. It's a self-fulfilling prophecy coded into the financial system itself. Research has consistently shown that these algorithmic systems perpetuate and sometimes even amplify existing inequalities. They create barriers that are nearly impossible to challenge because they're invisible and complex. You can't argue with an algorithm or appeal to its sense of fairness. You can't show it your reliable payment history with your landlord if that data isn't being captured in your credit file. So, what can be done? Some experts argue for more inclusive data. If algorithms had access to information like consistent rent payments, utility bills, and other financial behaviors not traditionally captured in credit scores, they might make fairer assessments. Others push for greater transparency in how algorithms make decisions, allowing for more effective challenges to discriminatory patterns. But in the meantime, millions of Americans face a financial system where the gatekeepers are invisible and the rules are unknowable. When you're denied a loan or offered worse terms than someone with an identical financial profile but a different name or zip code, you may never even realize the discrimination that's occurred. The psychology of poverty, how financial exclusion shapes mindsets. When you think of poverty, what images come to mind? Maybe it's empty bank accounts or struggling neighborhoods. But what if I told you poverty doesn't just affect your wallet, it physically rewires your brain? The science behind this is shocking, and it explains why breaking free from financial hardship is so much more complex than just working harder or making better choices. Living with constant financial stress triggers profound biological changes that alter how your brain functions. When you're constantly worried about making rent or putting food on the table, your body produces elevated levels of cortisol, the primary stress hormone. This isn't just feeling anxious, it's a physiological response that floods your system and stays elevated when you face chronic financial uncertainty. High cortisol levels over extended periods don't just make you feel stressed, they literally reshape your brain. The prefrontal cortex, which handles decision-making and self-control, becomes compromised. Your ability to plan for the future, weigh consequences, and make sound financial decisions diminishes, not because of laziness or poor character, but because of actual biological changes happening in your brain. Children growing up in poverty experience even more dramatic effects. Research shows they develop reduced volumes in critical brain regions like the hippocampus, which is essential for memory formation, and the prefrontal cortex, crucial for planning and impulse control. These aren't small differences, they're structural changes visible on brain scans that directly impact learning ability and cognitive development. When a child's brain is developing under the constant stress of poverty, these changes create real obstacles to academic success. Imagine trying to focus on algebra when your brain is constantly scanning for threats because it's been wired for survival rather than learning. It's not that children in poverty can't learn, it's that their brains are being asked to perform complex cognitive tasks while simultaneously managing overwhelming stress responses. What's particularly troubling is how these brain changes affect executive function, the mental processes that help us organize information, regulate emotions, and exercise self-control. When executive function is compromised, it becomes significantly harder to do things like stay organized, complete long-term projects, or resist impulse purchases. All skills that are essential for financial planning and advancement. This leads to what researchers call mental bandwidth poverty, the idea that dealing with financial scarcity consumes so much of your cognitive capacity that you have less mental resources available for everything else. When you're constantly calculating how to stretch your last $20 until payday, your brain has less capacity for thinking about career advancement, education opportunities, or retirement planning. Think about it like this. If your mental bandwidth is measured in gigabytes, poverty forces you to run dozens of stressful financial calculations in the background of your mind at all times. This constant background processing drains your cognitive resources, leaving you with less available RAM for other important life decisions. It's not a lack of intelligence or motivation, it's a shortage of available mental bandwidth. Even more alarming is how poverty-induced stress affects your body at the cellular level. Research indicates that the chronic stress of financial insecurity can lead to shortened telomeres, the protective caps on your chromosomes that prevent cellular damage. Shortened telomeres are associated with accelerated aging and increased risk of numerous health conditions from heart disease to depression. This means poverty doesn't just make life harder today, it can literally shorten your lifespan by accelerating the aging process at the cellular level. When you're struggling financially, your body pays the price biologically in ways that compound over time, creating health challenges that further limit your ability to advance economically. The psychological impact of living in poverty creates a particularly vicious cycle. financial stress triggers biological changes that impair decision-making. Impaired decision-making leads to choices that may worsen financial situations. Worsening finances increase stress. And the cycle continues, becoming increasingly difficult to break with each turn. Children raised in these environments often experience emotional and behavioral dysregulation as their developing brains adapt to chronic stress. Their IQ scores may be lower, not because of inherent differences in intelligence, but because poverty creates biological barriers to cognitive development. These factors severely limit their ability to succeed academically and socially, perpetuating the cycle of poverty into the next generation. What's crucial to understand is that these responses aren't character flaws or personal failings, they're biological adaptations to chronic stress. When politicians or commentators suggest that people in poverty just need to make better choices or work harder, they're ignoring the fundamental reality that poverty itself creates biological barriers to doing exactly those things. It's like telling someone with a broken leg to just try harder at running. The problem isn't motivation. It's that there's a very real physical barrier that must be addressed before progress can happen. For people trapped in poverty, that barrier exists in their brain chemistry and neural pathways that have been shaped by constant financial stress. This explains why programs that only provide financial literacy education often fail to create lasting change. Knowing how to budget or save is valuable, but if your brain's executive function is compromised by chronic stress, implementing that knowledge becomes incredibly difficult. True interventions must address both the knowledge gap and the biological impacts of poverty. The good news is that these changes aren't permanent. Research shows that when financial stress is reduced, many of these biological effects can begin to reverse. When families receive adequate financial support, children's brain development improves, stress hormones decrease, and cognitive function enhances. This suggests that effective anti-poverty programs aren't just about economic justice, they're investments in brain health and cognitive potential. Understanding this biological reality helps explain why breaking the cycle of poverty is so challenging. It's not just about making better financial choices. It's about creating environments where people's brains aren't constantly battling the biological effects of chronic stress. This requires approaches that address both immediate financial needs and the underlying psychological impacts of poverty. For individuals experiencing these challenges, recognizing that your struggles aren't personal failings, but biological responses can be the first step toward developing effective coping strategies. Simple techniques like mindfulness practice, regular physical exercise, and building strong social connections can help mitigate some of the biological effects of poverty-induced stress. But individual coping strategies aren't enough. We need systemic changes that recognize and address the biological toll of poverty. Programs that provide consistent financial support, affordable healthcare, quality early childhood education, and stress-reducing community resources can help break the cycle by addressing both the financial and neurological dimensions of poverty. Generational poverty: why the cycle is so hard to break. The biological toll of poverty doesn't end with one generation. It creates a powerful cycle that can trap families for decades. Think about this. A child born into poverty today isn't just fighting their own financial battles, they're fighting against a system of compounding disadvantages that their parents and possibly grandparents couldn't overcome either. Let's talk about generational poverty, a familial pattern that persists across at least 2 generations. This is fundamentally different from situational poverty, which happens when a family experiences temporary financial hardship due to a specific crisis like job loss or medical emergency. When poverty becomes generational, it creates a much more stubborn and complex problem to solve. What makes this cycle so difficult to break? It's not just about empty bank accounts, it's about compounding disadvantages that stack up over time, creating what economists call a poverty trap. Each obstacle makes the next one harder to overcome, creating a downward spiral that's incredibly difficult to escape. Let's look at education first. Kids growing up in poverty often attend schools with significantly fewer resources. Their textbooks might be outdated, technology limited, and classrooms overcrowded. And it's not just about material resources. These schools often struggle to attract and retain experienced teachers. When you're learning from a revolving door of substitute teachers or inexperienced educators, your academic foundation suffers. This educational disadvantage directly impacts future job opportunities. Without strong academic preparation, higher education becomes less accessible, and well-paying jobs move further out of reach. The cycle continues as lower earnings mean these young adults can't build the financial cushion needed to weather emergencies or invest in opportunities that could improve their circumstances. The health consequences are equally devastating. Children raised in generational poverty face higher risks for chronic health conditions that follow them into adulthood. These aren't just minor ailments. We're talking about serious conditions like cardiometabolic diseases and arthritis. These health challenges don't just affect quality of life. They directly impact work capacity and earning potential. How can you maintain consistent employment when chronic health issues regularly force you to miss work or limit the types of jobs you can perform? Environmental factors pile on additional challenges. Low-income neighborhoods often face higher crime rates, environmental pollution, and limited access to fresh food and green spaces. These aren't just inconveniences, they're serious barriers to health, safety, and opportunity that make escaping poverty exponentially harder. Perhaps one of the most underappreciated aspects of generational poverty is the absence of a financial safety net. Middle-class families often provide critical support during young adulthood, helping with college tuition, offering a place to stay between jobs, co-signing for apartments, or providing startup capital for entrepreneurial ventures. Without this safety net, a single financial setback can derail progress for years. Consider what happens when a young person from a middle-class family has their car break down. They might call their parents for help with repair costs or borrow a family vehicle temporarily. For someone from generational poverty, that same car breakdown could mean losing their job due to transportation issues, which could then trigger eviction, further debt, and a cascade of other financial problems. The psychological dimension compounds these challenges. Growing up in poverty shapes how you view your possibilities in life. When you've never seen anyone in your family or community escape poverty, despite hard work, it becomes difficult to envision a different future for yourself. This isn't a failure of imagination. It's a rational response to observed reality. What's particularly insidious about generational poverty is how the duration of childhood poverty strengthens its grip. Research shows that the longer a child spends in poverty, the more likely they are to experience poverty as an adult. This isn't coincidence or bad luck. It's a predictable pattern with biological, educational, and economic roots. Just consider the data. Studies indicate that adults who experience poverty during childhood have significantly higher poverty rates in early and middle adulthood, and this likelihood increases with each additional year spent in poverty as a child. It's like trying to climb out of a hole that gets deeper with each generation. With all these compounding disadvantages piling up generation after generation, you might wonder, is escaping generational poverty even possible? Can someone break free from a cycle that's been strengthened over decades? The answer isn't simple. While individual success stories exist and should be celebrated, they often mask the extraordinary effort and luck required to overcome these barriers. Think about climbing Mount Everest. It's technically possible, but requires exceptional preparation, support, and favorable conditions. Even the most determined climber can be thwarted by factors beyond their control. Similarly, escaping generational poverty requires not just personal determination, though that's important, but also access to resources, opportunities, mentorship, and often a significant dose of good fortune. The path out is neither straightforward nor guaranteed, even for the most talented and hardworking individuals. What makes generational poverty so persistent is that it's not about individual failings. It's a system of interconnected barriers that become more difficult to overcome with each generation. Each disadvantage reinforces the others, creating a complex web that traps families despite their best efforts to break free. Effective interventions need to address both the economic and psychological needs of families caught in this cycle. This means providing support in education, healthcare, and financial literacy, while also addressing the deeper systemic issues that create and maintain these disparities. Programs that focus only on individual responsibility without addressing structural barriers are like telling someone to climb out of a pit without providing a ladder. Theoretically possible, but practically impossible for most. The most successful approaches recognize that breaking the cycle, the historical roots, how discriminatory policies created today's wealth gap. Systemic change sounds impressive, but have you ever wondered exactly which systems need changing? Behind today's trillion-dollar racial wealth gap lies a series of government policies that actively subsidized wealth building for some Americans while deliberately blocking others based solely on their race. This isn't ancient history. It's the foundation of our current economic reality. When we look at home ownership, the primary way most Americans build wealth, the numbers tell a shocking story. The gap between black and white homeownership is actually wider today than it was during Jim Crow segregation. This isn't some unfortunate accident or the result of individual choices. It's the predictable outcome of deliberate policy decisions that continue to shape our economy. Let's travel back to the 1930s, when the federal government created programs to help Americans recover from the Great Depression. The Homeowners Loan Corporation and the Federal Housing Administration were established to help Americans buy homes with government-backed loans. Sounds great, right? Except there was a catch. These agencies literally drew red lines on maps around neighborhoods with high black populations, marking them as hazardous for investment. This practice, redlining, made it virtually impossible for residents in these communities to get approved for home loans, regardless of their income or creditworthiness. Meanwhile, the government eagerly subsidized loans in white neighborhoods, helping those families build equity that would grow for generations. Think about what this meant in practical terms. While white families could buy homes for as little as $8,000 in the 1950s with government-backed loans, black families were systematically locked out of these opportunities. As these homes appreciated in value over decades, often increasing 10 to 20 times in value, white homeowners built wealth while black renters paid money that disappeared each month. After World War II, the wealth-building machine kicked into high gear with the GI Bill. This transformative legislation helped millions of returning veterans go to college and buy homes with little or no money down. It's often credited with creating the American middle class, but this middle class was overwhelmingly white. While the GI Bill's text didn't explicitly exclude people of color, its implementation certainly did. Black veterans often couldn't use their benefits because many colleges didn't accept black students. And when they tried to use housing benefits, they encountered redlined neighborhoods and discriminatory lending practices. Of the 67,000 mortgages insured by the GI Bill in New York and northern New Jersey after World War II, fewer than 100 went to non-white borrowers. These weren't just minor inconveniences, they were systematic barriers that prevented entire communities from building wealth during America's greatest period of middle-class prosperity. And the effects compound over time. Consider what happens when one family builds home equity for generations while another remains stuck in rental housing. Today, the median wealth of households with a black householder stands at just $24,520, approximately 1/10 of the median wealth of households with a white householder at $250,400. That's not a gap, it's a chasm. This wealth disparity continues through inheritance patterns. White families are far more likely to receive significant inheritances than black or Hispanic families. When parents own homes, they can pass down that wealth or use home equity to help their children with down payments on their own homes, college tuition, or starting businesses. Without this foundation, each generation starts from scratch. The discrimination didn't stop with housing. Throughout the 20th century, labor unions offered pathways to middle-class wages, but many explicitly excluded black workers. Social Security initially excluded domestic workers and agricultural laborers, occupations that were predominantly filled by people of color. Even when these exclusions were eventually removed, decades of lost benefits couldn't be recovered. Urban renewal programs in the 1950s and 60s, supposedly designed to improve cities, often destroyed thriving Black business districts and neighborhoods. Highways were routinely built through Black communities, destroying property values and splitting neighborhoods, while white communities had the political power to block similar construction. What makes this history particularly insidious is how invisible it becomes over time. The racial wealth gap today looks like the natural outcome of market forces to many Americans, when in reality, it's the predictable result of policies designed to create exactly this outcome. Fast forward to more recent history, and we see the same patterns repeating. During the 2008 housing crisis, predatory lenders targeted Black and Latino homeowners with subprime mortgages, even when many qualified for standard loans. The resulting foreclosure crisis wiped out more than half of Black wealth in America, erasing decades of progress in a few short years. Even today, studies consistently show that homes in predominantly Black neighborhoods are undervalued by appraisers compared to identical homes in white neighborhoods. One study found that homes in Black neighborhoods are undervalued by an average of 23%, representing about $48,000 per home in lost equity. Multiply that across millions of homes, and you're looking at trillions in missing wealth. The cumulative effect of these policies is staggering. By some estimates, the average wealth of Black families is approximately $1 million less than that of white families. This isn't about individual choices or work ethic, it's about systems designed to create and maintain economic inequality. Some people might argue, but those policies are in the past. We have anti-discrimination laws now. And yes, we do have fair housing laws on the books. But the wealth gap continues to widen because wealth compounds over time. When one group starts with a massive advantage, even equal treatment moving forward, which we haven't actually achieved, doesn't close the gap. It freezes it in place or allows it to grow even wider. Think of it like a race where one runner starts miles ahead of the other. Even if both runners move at the same speed from that point forward, the gap never closes. In reality, our economic race still has different rules for different runners. This leaves us with an important question. If these systems were deliberately created through policy choices, can they be deliberately changed? Can we design new policies that actively close the wealth gap rather than maintaining it? The evidence suggests we can. Just as government policies helped create the white middle class in the mid-20th century, targeted policies could help build wealth in communities that have been systematically excluded. This isn't about handouts. It's about creating equal access to the wealth-building tools that some Americans have enjoyed for generations. The income gap, how wage disparities fuel wealth inequality. Equal access to wealth-building tools sounds promising, but what happens when your starting capital is systematically smaller than everyone else's? The wage gap in America isn't just about different numbers on a paycheck. It's the invisible barrier that keeps financial freedom permanently out of reach for entire communities, even when they're working harder than everyone else. For every dollar a typical white worker earns in America, a Black worker earns just 84 cents. And a Hispanic or Latino worker earns a mere 76 cents. These aren't just abstract statistics. They represent thousands of dollars in lost income every year that could have gone toward building wealth. While many try to explain away these disparities by pointing to education levels or work experience, the reality is far more troubling. According to the Economic Policy Institute, these factors explain less than half of the compensation gap between Black and white workers. Something else is clearly at play. What's especially concerning is how these wage gaps have widened over time rather than improved. From 1979 to 2019, median wages for Black workers increased by only 5.2%. That's barely keeping pace with inflation over 4 decades. Meanwhile, white workers saw their wages grow by 20% during the same period. This isn't progress. It's a widening divide that mirrors the growing wealth gap between the rich and poor across America. Think about what this means in practical terms. If you're earning 20% less than your counterpart, that's not just 20% less spending money, it's 20% less you can save, 20% less you can invest, and 20% less compound interest you'll earn over your lifetime. These wage disparities don't just affect your current standard of living, they dramatically reduce your ability to build wealth for the future. When you're living paycheck to paycheck because of systematically lower wages, investing in stocks or saving for a down payment on a home becomes nearly impossible. Occupational segregation plays a huge role in maintaining these disparities. Workers of color are often funneled into lower-paying industries and positions with limited advancement opportunities. This isn't about individual choices. It's about systemic barriers that restrict access to higher-paying roles and industries. The playing field isn't level when certain communities are systematically pushed toward jobs with lower earning potential and fewer benefits. Another crucial factor is the decline of union membership, which has fallen dramatically from over 30% of American workers in the 1940s to just 10.1% in 2022. This might seem unrelated to racial wage gaps, but unions historically provided one of the most effective pathways to middle-class wages for workers of color. Collective bargaining helped ensure fair pay regardless of race or gender, and as union power has diminished, so has this equalizing force in the labor market. The consequences of these wage disparities compound over time in ways that are difficult to overcome. Take two workers who start their careers at the same time, one earning $50,000 and another earning $40,000 due to the wage gap. Even if both save 10% of their income and earn the same investment returns after 40 years, the higher-earning worker will have accumulated substantially more wealth simply because they had more capital to invest from day one. What makes this situation particularly frustrating is that these disparities aren't improving fast enough. The racial wage gap has narrowed slightly since the early 2000s, but this modest progress is dwarfed by how much the gap grew between 1979 and 2023. We're still far from equality, and at the current pace, it would take decades to close these gaps completely. The managerial class has reaped disproportionate benefits from economic growth over recent decades. From 1996 to 2019, the average hourly wage for managerial and supervisory employees increased by a whopping 50%, while production and non-supervisory workers saw their earnings grow by just 25.5%. This widening gap between workers and management has coincided with growing racial wage disparities, as people of color remain underrepresented in management positions. These wage inequalities fuel a vicious cycle that makes building generational wealth nearly impossible for many families. Without adequate income, it's extremely difficult to save for emergencies, let alone make investments that appreciate over time. This helps explain why, in 2021, the typical white household had 9.2 times as much wealth as the typical black household, $250,400 compared to just $27,100. The wage gap is the foundation upon which the wealth gap is built. The richest Americans have seen their fortunes grow at an astounding rate compared to everyone else. The average income of the richest 1% has grown 17 times faster than the income of the bottom 20% of earners from 1979 to 2020. This extreme inequality doesn't just affect the very bottom. It squeezes the middle class and disproportionately impacts communities of color who are already dealing with systemic wage disparities. This is why addressing the wage gap is so crucial for achieving any meaningful progress on wealth inequality. You can't build wealth without capital, and you can't accumulate capital when your paycheck is systematically smaller than others doing the same work. Financial literacy and smart investing strategies are important, but they can only take you so far when the system starts you with less and keeps you earning less throughout your career. The wage gap isn't just an economic issue. It's a deeply personal one that affects millions of Americans every day. It means working just as hard but having less to show for it. It means delaying homeownership or never achieving it at all. It means struggling to help your children through college while others can do so easily. It means retiring with less security and passing down less wealth to the next generation, perpetuating the cycle. Breaking through. Community solutions to financial exclusion. While wage gaps perpetuate cycles of inequality, a quiet revolution is happening in neighborhoods across America that mainstream financial media rarely covers. community-based financial institutions are proving that when traditional banks abandon neighborhoods, collective power can fill the void, creating wealth-building opportunities that were previously impossible. Take Varsovia Fernandez, the first executive director of the Pennsylvania CDFI network. When she saw how minority-owned businesses struggled to access capital, she didn't just highlight the problem, she orchestrated a solution. Under her leadership, the network secured an impressive $45 million allocation from the state Small Business Credit Initiative to support minority-owned businesses throughout Pennsylvania. This funding is transforming communities by providing resources to entrepreneurs who've been systematically denied traditional financing. This isn't an isolated success story. Across America, marginalized communities are refusing to wait for Wall Street to solve their financial exclusion. Instead, they're building their own financial infrastructure from the ground up. Community Development Financial Institutions, CDFIs, form the backbone of this alternative financial ecosystem. Unlike traditional banks that prioritize profit above all else, CDFIs are mission-driven lenders specifically focused on low-income, low-wealth communities. They provide essential capital for small businesses, affordable housing projects, and community facilities in neighborhoods that mainstream banks have written off. The impact is substantial. In just 1 year, members of the Opportunity Finance Network, a national association of CDFIs, supported 11,000 small businesses and created or maintained nearly 100,000 jobs. This success wasn't achieved through market rate lending, but through philanthropic funding that prioritized community needs over excessive profits. These community-based solutions address a critical gap. Black and brown business owners frequently struggle to secure working capital, often forcing them to turn to predatory lenders, charging exorbitant interest rates. CDFIs offer a lifeline, providing reasonable loans with supportive terms that build rather than extract wealth from the community. Beyond traditional lending, innovative financial models are emerging to meet unique community needs. Lending circles, for example, allow groups of individuals to pool their resources and provide loans to one another. This ancient practice, it's common in many cultures worldwide, has been formalized and scaled by organizations serving immigrant and minority communities. Participants build credit while accessing capital without the predatory terms typical of alternative financial services. Community investment funds represent another powerful innovation. These funds pool capital from community members and socially conscious investors to support local development projects. Unlike traditional investment vehicles that extract wealth from communities, these funds recirculate money locally, creating sustainable economic growth from within. Minority-owned banks and credit unions play an equally crucial role in building community wealth. Many were established specifically to serve communities excluded from the traditional banking system, and they continue this mission today by providing culturally competent financial services. Staff members typically come from the communities they serve, creating an environment where customers feel understood and respected, a stark contrast to the intimidating atmosphere many experience at mainstream financial institutions. These institutions don't just offer basic banking services, they actively reinvest in their neighborhoods. When you deposit money in a minority-owned bank, those funds help finance homes, businesses, and community projects in areas frequently overlooked by larger institutions. This creates a virtuous cycle of investment and development that benefits everyone in the community. The Finance Justice Fund exemplifies this approach to community investment. Established by the Opportunity Finance Network, this initiative specifically targets the racial wealth gap and persistent poverty by financing projects in Black, Latino, Native, rural, and other chronically underinvested communities. By channeling resources directly to these areas, the fund creates opportunities for wealth building that would otherwise be impossible. Of course, these community-based financial solutions face significant challenges. They're fighting against decades of disinvestment and competing with massive financial institutions with billions in assets. Many operate on razor-thin margins and depend on grants and subsidies to sustain their work. But despite these obstacles, the movement is gaining momentum. more investors recognize the social and financial returns possible through community finance. Foundations are increasing their support for these initiatives. And most importantly, communities themselves are organizing to build financial power from within. What makes these solutions particularly effective is their holistic approach. CDFIs and community banks don't just provide access to capital. They offer financial education, business advice, and ongoing support. This comprehensive model addresses both the immediate need for financing and the long-term goal of building financial capability within the community. For example, when a small business owner receives a loan from a CDFI, they typically also get assistance with business planning, marketing strategies, and financial management. This support dramatically increases the likelihood of success compared to simply receiving money with no guidance, the approach taken by many traditional lenders. The interest rates offered by community-based financial institutions also make a crucial difference. While predatory lenders might charge 400% APR or more, CDFIs typically offer rates comparable to or lower than mainstream banks. This means borrowers can actually get ahead instead of falling into deeper debt with each payment. These community-based solutions are proving that financial exclusion isn't inevitable. When people organize and build their own institutions, they can create pathways to wealth that circumvent the traditional system's barriers. What's particularly powerful about this approach is that it builds community wealth and individual wealth simultaneously, strengthening the entire neighborhood while helping individuals advance financially. The ripple effects extend far beyond individual borrowers. When a small business receives funding from a CDFI and succeeds, it creates jobs, provides needed services, and contributes to the local tax base. When a family buys a home through a minority-owned bank, they build equity while stabilizing the neighborhood. Each success strengthens the community's economic foundation. These financial networks are gradually changing the landscape in neighborhoods that have been financial deserts for generations. Streets that once had only check-cashing stores and payday lenders are seeing community banks, credit unions, and CDFI offices open. Instead of extracting wealth, these institutions circulate personal strategies, tactical approaches to beat a rigged system. Beyond community solutions lies the territory of individual action. While these collective initiatives are transforming neighborhoods, they can't help everyone immediately. That's where personal tactical approaches come in. The financial resistance strategies that work even when the system isn't on your side. Understanding the system isn't rigged against you personally. It's rigged against your community, is the first step to developing effective counter-strategies. Once you recognize these barriers aren't your fault, you can approach them strategically rather than internalizing the struggle. Let's talk about practical ways to navigate and overcome these systemic financial barriers. I won't sugarcoat it. These strategies require more effort than they should, but they've been proven effective by people who've successfully built wealth despite facing tremendous odds. First up, credit optimization techniques that work even with algorithmic bias. Secured credit cards are a powerful tool for anyone with limited or damaged credit. Unlike traditional credit cards, these require a cash deposit that serves as your credit limit. This deposit minimizes the risk for the lender while allowing you to demonstrate responsible credit use. Every on-time payment gets reported to credit bureaus, gradually building your credit profile. Credit builder loans offer another effective pathway. These unique loans work differently than traditional ones. The money you borrow is held in a bank account while you make payments. Since the lender isn't actually giving you access to the funds until you've completed the payments, their risk is minimal. Meanwhile, your consistent payment history gets reported to credit bureaus, boosting your score month by month. Here's a credit building strategy many people overlook. Getting your rent payments reported to credit bureaus. Most landlords don't report these payments automatically, but services exist that will report your on-time rent payments for a small fee. Since housing is typically your largest monthly expense, having this payment history recognized can significantly enhance your credit profile without taking on additional debt. These strategies aren't just theoretical, They're being used right now by individuals who've been systematically excluded from traditional credit pathways. But building credit is just one piece of the puzzle. Investing remains one of the most powerful wealth-building tools, and there are approaches that work even with minimal starting capital. Micro-investing apps have revolutionized access to the market by allowing you to invest spare change or small amounts into diversified portfolios. Some platforms let you start with just $5, removing the traditional barriers to entry. These apps typically offer pre-built portfolios based on your risk tolerance and goals, making investing accessible without requiring deep market knowledge. Fractional shares represent another accessibility breakthrough. Instead of needing hundreds or thousands of dollars to buy a single share of high-performing companies, you can purchase a fraction of a share with whatever amount you can afford. This means you can own pieces of companies like Amazon or Google with just $10 or $20, gaining exposure to their growth potential without a large upfront investment. Community investment opportunities provide both financial returns and local impact. Local crowdfunding platforms allow you to invest in small businesses or community projects in your neighborhood. These investments typically have lower minimum amounts than traditional securities and create a double bottom line, potential financial returns for you and economic development for your community. The most underutilized asset for many people is their own skills and time. Income acceleration methods beyond traditional employment can create financial breathing room that makes other wealth-building strategies possible. Skills-based side hustles leverage what you already know or can learn quickly. The key is identifying marketable skills that you can offer without significant startup costs. This might be tutoring in subjects you excelled in, offering bookkeeping services if you're good with numbers, or providing translation services if you're bilingual. Online platforms have dramatically lowered the barriers to monetizing these skills. Whether it's freelance writing, graphic design, virtual assistants, or countless other services, these platforms connect you directly with potential clients worldwide without requiring expensive credentials or equipment. The flexibility allows you to earn additional income without sacrificing your main job or family responsibilities. Don't overlook the power of community networks in creating income opportunities. Collaborative projects where individuals pool their complementary skills can create offerings more valuable than what any one person could provide alone. These networks also share resources like equipment, workspace, or childcare, reducing individual costs while maximizing earning potential. What makes these strategies particularly powerful is how they work together. Credit optimization creates access to more affordable financing. Better financing terms allow for strategic investments. Investment returns and increased income create more capital for additional investments. This positive feedback loop can gradually overcome systemic disadvantages. Many of these approaches don't just build individual wealth, they strengthen community resilience. When you invest in local businesses through community investment platforms, you're creating jobs and economic activity in your neighborhood. When you develop marketable skills, you become a resource for others in your community. This ripple effect means your personal financial progress contributes to collective advancement. These strategies can't fix systemic discrimination overnight. They require persistence, creativity, and often more effort than should be necessary. But they provide a pathway forward while the slower work of systemic change continues. The financial establishment doesn't advertise these approaches because they often bypass traditional profit centers, but that they're being used successfully by people in communities facing the toughest barriers. Success in this context doesn't always look like wealth by conventional standards. It might mean achieving stability when instability was the norm in your family. It might mean being the first homeowner in generations. It might mean creating opportunities for your children that you never had. These achievements represent profound victories against structural barriers. The most important mindset shift is recognizing that working around systemic barriers isn't accepting them. It's a form of resistance. Every time someone builds wealth despite a system designed to exclude them, They're proving that system's limitations and creating momentum for change. The financial system doesn't need fixing because it's not broken. It's intentionally designed to create obstacles for marginalized communities. But knowing is half the battle. By understanding these barriers, we can develop powerful strategies to overcome them. Real financial liberation requires a two-pronged approach. We need personal tactics that help us navigate around obstacles, but we also need collective action to reshape the systems perpetuating inequality. That's where advocacy for fair lending practices becomes crucial. Working together to increase access to financial education and supporting community-based financial networks creates pathways that didn't exist before. Yes, your financial journey might be more challenging because of these systemic barriers, but it's absolutely possible to succeed. Every step forward helps break generational cycles of exclusion. When we combine individual resilience with community power, we create unstoppable momentum toward a more equitable financial